Okay, welcome everybody to the Saturday morning webinar series. This is a special webinar with we have Dr. Ken Long here, and he's here to talk about the templates in EdgeRater. We'll look at some of the signals that are current in the market, and he'll have a lot more to say about how he looks for signals, what he's looking for, and the trading aspect of that as well. But what I thought we'd do at the beginning, just to start with, is just take a look at the market review. So I have a couple of slides here and obviously the disclaimer, as always, this is just educational purposes. So not recommending to buy and sell any stocks. That's important. You've probably seen this slide if you've been to one of the previous seminars. So there's a lot that has been produced this year, and the thing that is really exciting are the templates that we produced in conjunction with Ken Long, and that is what we're here to talk about. 6 months ago, we got online and we talked about just the philosophy behind these signals. And when I hand over to Ken, he might talk a bit more about that. I'm not sure. But then we'll take a look closely at the signals. That's something we didn't get a chance to do last time, was actually look at the live signals in the market and take a look at some of those stocks. But the quick market review I have is to do with this Hindenburg omen, because this is something that doesn't appear very often in the market, and it's been showing itself quite frequently for the last, the last couple of weeks. And so if you've been to the previous seminars, or webinars, you've probably seen this chart that I produced, which is basically these Hindenburg omens. It's a way of detecting, it was designed as a way of detecting potential market tops. And the calculation for it is based on the New York Stock Exchange symbols, and looking for a number of new highs and the number of new lows. And it's basically saying if you've got a high percentage of new highs and a high percentage of new lows, something is weird in the market. And then there's also a check in there to see if the number of new lows is increasing and sort of outweighing the number of new highs. And also the final check, because there are 4 conditions, is that there has to be a rising moving average. And so we have a template in EdgeRater to check all those conditions, and they rarely fire, but they have been firing recently. So this chart here, you might recognize as the SPY going back from 2020, just before this drop. I'm not sure if you can see where my cursor is pointing, but on the left-hand side where it says 2 Hindis, there was a drop there, and you had just 2 Hindenburgs fire at that point. But, several weeks before that drop, but they were firing, and those conditions were all met. And then as we got up to no signals were firing in the recovery and beyond that. And then when the market got to a topping position again, you had another 3 firing, another 2, and another 3 down here. But they also fire on the way out of these conditions. So, there were 2 that fired here. It didn't lead to anything significantly bad. And there were 3 that fired up here, which did lead to a little drop. So something just to pay attention to. And I thought, seeing as I produced this slide, I would continue to follow up. This slide was produced on June the 4th. And so there've been a few trading days since then. And so, so this morning, I put this template, the latest version of this template, I just gave it to ChatGPT, and I asked it to just plot me a chart because I was feeling a bit lazy. And it just came up with this chart. This is, again, it's SPY for 10 years of SPY, and the red dots are actually where the Hindenburg omens have occurred. This is on logarithmic scale, so you might not recognize the exponential nature of SPY when it's put on this log scale. But you can see at where we are now, we have just a bunch of these Hindenburg omens firing. It doesn't always lead to a downturn in the market, but there's never been a market correction without Hindenburg omens firing. And so that's why we need to kind of just pay attention to when they start appearing. So with that, I thought I would just go over to EdgeRater. And the other thing we look for with a market breadth type of analysis is to see where stocks in the S&P 1500 are in relation to their Bollinger Bands. And we have this report called the Percent B Buckets report. And as of Friday, which is the 7th, 28th, there we go, 28th. We're just coming out of this bad period where the majority of stocks were below their mid Bollinger Band. And it's been pretty rough for the last, since May, really. It's been the majority of stocks have been below their mid Bollinger Band since down here. We can see that there were 82% below, and then we worked our way out from that position. So we're just coming into a point now. There were 2 times this week where the number of stocks went above 50%, and we're now hovering just at 50% above the mid band. So there's two sort of, let's say, breadth indicators that are one of them. The bucket report is kind of indicating that things are normalizing a bit and getting a bit better. And then the Hindenburg Omen is saying, pay attention because there are lots of new highs and new lows, which is a bit of an anomaly. So that's where we are. And I just wanted to update everybody with that. Now, go back to my slides. And we have with us, Dr. Ken Long. And 6 months ago, we were online and we talked about these new templates in EdgeRater. And so at that time, we did say we would come back and we'd take a look at some of the signals in the market and look at what is occurring. And that was the plan. That's the plan today. We're going to take a look at the live market. I'm going to hand over the screen to Ken in a second, and then he will also get me to drive EdgeRater, and I'll show some of the signals that are occurring, and he can walk through that. So good morning, Ken.
Hey, good morning, Chris. Good day to everybody out there. Sure do appreciate your time and attention. I just got to wonder about your priorities while you're listening to us on a Saturday morning. But, birds of a feather flock together, I suppose. Yeah, can I go ahead and share my screen, you think?
Yeah, I think you should be enabled for that. So.
Okay, yeah, here we go. So the central idea that I want to share here is the idea of a critical state. And your introduction with the Hindis couldn't have been more timely, because in a real sense, the Hindi signal is evidence that we could be approaching a critical state, that something unusual is going to happen. And when you're a swing trader, what you really want is unusual things to happen. And so I try to look at price action and the conditions of the market to say, how close are we to being surprised? Are we more likely to have something unusual occur? In the old cowboy and Indians movies at 3 o'clock in the morning, there's always that moment. It's quiet. Yeah, it's too quiet. And then something's about to happen. So that's an example of a critical state, when you have the absence of all the usual activity and there's some kind of, there's a pause. Well, there's other critical states too. It's like we have a saying in the Army that if you're running through the desert with your hair on fire, oh, it's not showing. Let's try that again. If you're running through the desert with your hair on fire, you might be in a critical state. Let's see. Let me retry the share. See.
Yeah, I was getting it through on the other screen I have. It was coming through fine, so it might just be a one-off.
Yeah, I'm gonna retry that. Let's see how that goes. Is that any better?
think a number of people see it.
Okay. Well, the recording, I think we'll probably have it too. So let me talk again about a critical state. So I define a critical state as you're in a moment when there is a greater than normal chance of experiencing a larger than normal move in either direction in a shorter than normal period of time. And a couple examples of that might be you're in an explosion or you're on fire, the market's burning up. Well, by definition, you don't even have to wonder. Everything is in a mad rush. So that's the maximum volatility. That is a critical state. Normal rules of behavior no longer apply. Typical divergences or diversifications may no longer apply. And so there's new rules. You could also have a critical state where imagine a coiled spring that's under tension and under pressure, and it's starting to shake. And as soon as that thing releases, it's going to go. It's all that latent power has been built up, much like a Jack in the Box in the kids' musical production. They crank that little thing and you can hear the music and it's getting closer and closer. And then all of a sudden, boom, there it goes. On a longer term, you might think of an acorn from an oak tree as being a critical state. You have all the potential of a fully grown oak tree and all the oak trees that is going to spawn. An entire oak tree forest has been reduced and compressed and contained in a little package of potential just waiting to go. It doesn't explode, but it grows and just keeps going. So that's what I mean by a critical state. When you're in one of those, you should be prepared for larger than normal moves in either direction, shorter periods of time, and it's either already happening or it's potentially about to happen. If you can be prepared for that, then you have removed yourself from the herd psychology, which kind of moves along fat, dumb, and happy until they're surprised, and then fear and greed happen, and you get thunderous momentum. So we want to be prepared for that critical state. Now, when I talk about a compound critical state, I want you to think of it in this way. Traders in the market align with a time frame that feels comfortable, professional, successful for them. Like day traders like to trade during the day. Swing traders swing, position traders move on positions. And they develop systems and screens and habits and decision cycles that are geared towards the normal behavior most of the time for their little targets. And then they apply their systems. And they have pattern recognition or fundamental reasons to enter positions when it's just right. And then they start acting, and that action leads to price movement. But these guys are operating independently. And so sometimes something happens on your time frame that is surprising. How did that happen? Why am I getting more volume? Why did it make that size of a move? What's probably happening is that somebody in a different demographic, in a different time frame, had a system that triggered, and then they brought a bunch of money in and took a bunch of actions above and beyond your normal experience. And so you get this, we would think of that as noise, and we try to account for that by having wider stops or more refined entries or what additional parameters. And we just learn to accept the fact that the market has noisy behavior. But my assertion, my operating principle, my belief is that what you really have is a variety of demographics, each one optimized for their own time frame, working independently, but once in a while, the stars come into alignment. Key price levels are achieved. Volatility takes on certain characteristics. And now suddenly, all of these demographics are independently and unknowing of each other in a critical state themselves, and that creates a compound critical state. So you got multiple independent demographics of traders. Each one is ready for a sharp move, and then some trigger happens, and now you start getting price action, which triggers other reactions and momentum, and suddenly every one of them is surprised by the fact that we're in an avalanche style of a move. And when that happens and all the normal rules are blown away, you end up seeing a lot of fear and greed, all of which leads to waves of momentum. And it's that that is what we're looking for in our templates. We're looking for compound critical states. In order to trade those successfully, you have to be able to step outside of the herd mentality and not have a directional bias and be ready to accept the move as it is, to trade it within limits, and not to lose your head. In other words, you have to have standard work for abnormal conditions. I would think of a regular system for swing trading or day trading, whatever, any rule system as standard work for normal conditions. When we're in a compound critical state, we're going to add to that and we're going to create standard work for abnormal conditions. So if we look at this in a large sense, if the marketplace is where all the actions of you and all the other traders are happening, we all have a certain amount of tools, training, resources in the team, maybe to help us. And we're all operating from a baseline of our own skills, habits, psychology, all the way down into our beliefs and feelings, and even the shadows that are hiding from our conscious perception, but which are influencing our behavior. So we got this swirling mass of psychology that's always acting upon our rational mind. And that's what swing trading in critical states really taps into, is that as long as there are humans participating in the market, either directly as human traders or indirectly with their beliefs, creating systems that act on their behalf, as long as that human element is in there, you're going to see the pervasive impact of psychology and emotions. And swing trading is what's going to allow us to take advantage of short moves where market participants are readjusting their opinions and altering their positions in measurable periods of time, big moves, until a new normal is established and we can get back to the status quo. So I want you to think of swing trading as being part of that kind of mentality. Now, over the last 30 years, we put together an enormous, painful, detailed learning ecosystem. There's a lot of things going on because we support guys that are doing intraday trading, short-term swing trading, position trading, long-term buy and hold. So we've accumulated a series of processes and procedures that are based on the principles of statistics, discipline, practice, coaching, technique, standard work in order to be professional. What we have settled on as a way to put that into practice is what I would describe on this chart as a way to look at 3 different time frames that we would typically operate in: day trading, swing trading, and position trading. Day trading, we're looking at statistics based and normal moves and abnormal moves and trying to use discipline and procedure to offset the challenges of intraday trading. At the other end, on position trading, we're trying to find long-term persistent advantage for relative strength leaders across all the opportunities in the world in order to take advantage of longer-term momentum and let winners continue to win. The body of knowledge that we've built around swing trading occupies that middle ground, and it's an important middle ground because it ties together those 2 different time frames. It turns out that the swing trading targets that you generate turn out to be great intraday trading vehicles. Well, why is that? Well, because a successful swing trade is the manifestation of a directional move larger than normal over 3 to 10 days, kind of. And as long as you have that move that's happening in front of your eyes, you can see it. When you're looking at it on an intraday basis and it's moving in the primary direction of the swing, you already have a calibrated strategic plan, a template in which you can proceed to day trade and then exit that position with no overnight risk. And as long as that swing trade rule set is working and the exits haven't fired, then you're allowed to have a justified directional bias for intraday trading. So you don't have to, but you could. And if you have standard patterns that are fractal across all the time frames, and you can avoid an emotional commitment to the trade idea, it's possible for you to simply follow price intraday using the swing trade as a guide. Hey, well, it also works the other way. You could primarily be a day trader, and you might have a successful day trade that closed abnormally well, and you might get that 1 or 2 days in a row, and pretty soon that momentum becomes noticeable, and it triggers swing trades who are chasing momentum, and suddenly what was once a day trade all by itself can grow into a swing trade using the overnight risk to be paid for with markets money from the intraday. And so a day trade can grow into a swing trade, and swing trades can identify good turbo trading targets for day trading. Well, the same thing happens between swing trading and position trading. Sometimes that swing trade will just not stop, and it grows into a long-term relative strength leader and becomes a position trade. And through calibration and position sizing, you're able to grow a swing trade into a position that has paid for itself. By the same token, some of your longer term systems that are based on relative strength leaders already, they may find themselves in a short term critical state where if it resumes the trend, you get an advantageous entry. So it turns out that each of these three time frames, you can optimize systems for each one of them and develop skills, but you can also look for the information advantage that you get by blending them together in what we call core and turbo trading. Now, if all of these ideas are based on a common framework of discipline, self-regulation, gentle statistics, automated tools with amazing auto framing capabilities, all praise to Chris White. You managed to do what I've only been dreaming to try to do as a spreadsheet monkey myself. So I just got to admire you in public, and I hope you feel a little tinge of humble embarrassment. But boy, what a piece of work. So the idea now is, if I think about meta system management, what I can do is now bring the same standard principles of discipline, efficiency, effectiveness, systems thinking, constant risk management, and I can start to manage all of these systems collectively in a very efficient manner. What I end up having is a very integrated set of meta systems that I can manage in a standard professional way and use all the tools in all the time frames, whether I'm talking about monthly rebalancing all the way down to 1 minute aggressive intraday trading and all points in between. So that's what we mean by advanced adaptive swing trading. We use swing trading as the centerpiece of this information strategy because it is a self-contained approach to trading, but it also provides information that's useful to longer term position and shorter term day, and can receive information from those in order to make better swing trades. So that's my argument for swing trading. So what I want to say is, well, yeah, could I say something useful for you? Yeah, this little process right here, I think I could give a 3-month workshop on this one. And with your permission, I'm going to just walk through this and try to capture these ideas at a top level, and hopefully the replay function will let you zero on the things that are of interest and may also prompt some questions. I have basically unlimited time today, so it's raining and we canceled soccer, so I have freedom to answer questions. And you'd be helping me out if you ask questions, because otherwise my honey-do list is large, and I would rather answer questions than work around the house, if I'm being honest. So the central idea that we have, our central process, comes from the world of special operations and military operations. We call it plan, prepare, execute, assess. It's the sequence that we go through first as a planner to find candidates that are in compound critical states. And so we might start with a big list of symbols. Now, if you don't have EdgeRater, you might have to settle on 20 to 30 symbols to specialize in. But if you got EdgeRater, you're working potentially with 10,000 symbols to focus just on the patterns that you want. And then you could specialize in that. So the idea behind planning is that all I have to do is find symbols that are in a compound critical state. And from that list, maybe it's this one and this one and this one, I can find them falling into certain buckets of standard patterns that I'm proficient on. You don't need to know all of them. You just need to be good at the ones you're good at. So we're going to show a template here where we've got 6 different mechanical swing systems that test out really well. I would encourage you to take a look at Phil and Griff's swing trading system using EdgeRater and learning how to back test those systems with EdgeRater so you can find the exit strategy you like best. You're going to love the equity curve and the performance on just the mechanical patterns and just that template. A second template we're going to look at is the idea of the auto framer, which we ended up creating in order to take all of the ones that were firing on the mechanical systems, and we had an abundance of good ideas, and we used the auto framer to start calculating automatically the reward to risk ratio in order to prioritize those that gave us the best possible payoff for a standard amount of risk. After doing that for 5 years, it finally occurred to me that, oh, just the auto framer alone, just calibrating a target on standard rules of reward and risk in the swing time frame is itself a system of finding targets. And so we could actually not even rely on the mechanical patterns. We could just use the auto framer if we were able to trade based on trade location. Now, from that, we decided to expand into the sniper and say, now, if we bring in a certain category of patterns, and then we use specific trade techniques on how to trade those patterns, we're going to actually combine planning and craftsmanship into the execution phase. Now, in the execution phase, we're going to act as a sniper team who's taking the excellent targets that have been nominated and using EdgeRater as our teammate, we're going to execute ruthlessly, effectively, economically, and all we're going to do is follow the rules, which means we're going to follow the price. So if the planner is planning in order to find candidate targets, then the craftsman in the preparation phase is going to frame those up in a way that we can judge them on reward to risk ratio. We can take the best of those and bring them into the execution phase and simply be prepared for the rabbits to start running. And the first ones to move are the ones that we start working from a position of protected safety, risk management. It starts running, we take the shot. We don't know which way a rabbit's going to run, but we know that once he starts running, he's running, making a big move. So what do I mean by trade framing? Well, in the simplest way that I can, let me just suggest that in the planning phase, what we're doing is we're looking at the price action that has moved to a measured point and had a identifiable reversal, has then moved to this level where it had another identifiable reversal in the time frame that we care about. And from that, we can say that we've just identified the price channel that is active. The traders have established those as trade. I don't know why they did that. I don't want to know why they did that, because what would I do with that information? All I need to know is that's what they chose to do. That's what they chose to do. In fact, the beauty of this approach comes back to this idea, which says all I have to do is work on the actions that they're taking. And if I can act on that, I don't really have to worry why they did things. I just need to know that they're doing things. And is that normal or abnormal? And then I can take advantage of the herd mentality. So in the framing process, we start with something that we found was in a critical state or a compound critical state, and hopefully that little rascal has reduced into a compressed doji. I'm going to say that's a daily bar because we're talking about swing trading. Hint, if we were talking about position trading, that could be a weekly bar, a 3-day, a 9-day, a monthly bar, same concept. What we're looking for is a range compression because we're going to look at that range compression as the yellow zone of uncertainty. It's not until price breaks north or south of that compression zone that we have any new information that a new move has started. And we can say already from the turning points that we've identified, support and resistance and other statistical measures, we can say that it's not unreasonable if that moves for it to go back and test the previous price level. Or if it breaks out this way, to go back and test the previous price level because that's what it did last time. So that's not an abnormal or an unusual or an unreasonable claim. It could do what it's already recently done. Fight me, bro. Now, if I can use the doji as my area of uncertainty or risk, I can now use the auto framer concept to express the potential reasonable move in terms of reward to risk ratio. And I've ideally got 3-to-1 so that I can template 3-to-1, hope for 2-to-1, and accept 1-to-1. In actual practice, if I could see 3, plan and hope for 2, and then accept 1 unit of reward for every unit of risk, I'm a pretty happy trader. And so that little bit of pragmatism helps me to counteract my enthusiasm for trading. So in trade framing, what we're doing is taking any pattern that fires from any of these types of patterns, mechanical, auto framer, sniper, or others that we teach, and I apply my craftsmanship mind. I can now prepare the frame in both directions because remember, this is a compound critical state. It could make a larger than average move in either direction for no apparent reason, to my complete surprise. And so I'm not going to try to anticipate or predict. I'm just going to prepare to go in either direction. And then my sniper team is going to execute the plan by following the price when it leaves the box. If that's the little target box, if I can do it, the little bunny rabbit or a buffalo sitting inside there, as soon as he leaves the box, I'm on it. And then let's suppose that it's going long. My next job is to start immediately managing the exit. That's actually more important than the entry, as I'm going to explain here in a minute. The first decision that I have to make after I've entered according to a rule is to determine how soon my initial risk, which I'm just going to say is the bottom of the yellow zone, how soon can I move that stop to lock in what we call no lose plus dinner for 2. And by that, I mean, I'm higher than my entry. And if it comes back and hits my stop, I've paid for the trade and the slippage, and I have enough money to take my wife to dinner in Kansas. It's $100. You decide what that number is. But once I can get my initial risk to no lose plus dinner for 2, and I've locked in this little wedge, you can now adopt a professional mindset of a disinterested scientist who simply is performing a science project to see how much money your chosen exit rules are going to give you. And you're going to spend all your time developing better exit rules rather than trying to optimize the uncertainty of a better entry system. What you need is a good enough system with lots of opportunities that give you favorable reward to risk ratios in either direction that allow you to lock in these no lose plus dinner for 2 exits. And then if against all odds this thing keeps going up, what you're going to do is engage in ratchet behavior and keep raising that stop in a measured way according to the indicators that you're using so that you're giving it room to run, but you're preserving the amount of money that you need to be professionally satisfied. And then you're going to lock in those gains. And then at some point, you may see an exhaustion move or it starts to roll over at the expected resistance, and you jump up your stop and you exit that move. Now, psychologically speaking, what you've got to remember is that most of the people in the herd are trying to optimize the entry decision. But if you have a trade that works, you might end up making as many as 10 decisions on how to adjust your stop. You made the initial risk on the basis of your standard trade frame, so you don't even have to think very hard on that. You simply follow your trade template and you put the stop in, and then you're going to have a set of rules about when to move it to no lose plus dinner for two. And then every time it doesn't fail and moves up a distance and you start ratcheting in, you're using the same form of adaptive, responsive, reward to risk management update to start ratcheting your exits up. I hope you have to make 8 or 9 decisions to keep moving that stop up and up and up. And then the exit decision is not even your decision to make, because all you did was move your stop to the appropriate level, and the market decided that instead of continuing to go up, it rolls over and hits your exit. So you don't even have to make that decision. So in a really good trade, I want you to notice that if you had 10 decisions, only one of them has to do with the entry, and that's coming from a template anyway, and that's only 10% of your decision effort, and you should be spending 90% of your time on developing a set of trade management and exit management rules that you can live with routinely and professionally, and that you're not suffering. Like, that's why you get tired. That's where the stress comes from when you're trying to imagine new rules in the heat of the moment. Like, I'm riding a bucking bronco and I'm trying to decide, is there a better way to ride this, or should I try something else in my life? Is this really where I imagine? No, when you're riding a bucking bronco, hold on, right? And we'll figure it out later. So what I want to suggest is that you should spend about 90% of your time improving your rule set. And so if my basic rule set gives me this kind of performance and I can make a tweak after careful study, and now suddenly the same trades but with an improved rule set gives me that return, what you're doing at the systematic level is ratcheting and improving your rule sets in the same way that on an individual trade you're improving the capture of successful trades. And if you are skilled at finding compound critical states that give you 3-to-1 in either direction routinely, that are causing all of the other demographics to react with emotion, fear, and greed, and generating momentum, then you're going to be finding that your average wins are bigger than your average losses. And if this thing fails immediately, you don't mind, because it puts you into a better trade going the other direction. Well, if that's what the execution phase is all about, then we're not done until we have assessed. So if I'm supposed to find candidates, frame them, follow the price, and follow the rules, I'm not done until I'm finished. My dad used to tell me that. And what we're going to do in the assessment phase is do all of the learning that it takes to update new patterns, new trade techniques, refined exit management. We're actually going to learn from the way that we conduct our assessment to improve the way we journal our trades, conduct after action reviews, debrief ourselves, use feedback and feed forward in order to provide information to make adjustments. We're going to use system control charts to make sure that we're using data and systems thinking to make small, measurable, intentional changes to our rules one at a time so that we can test and then implement instead of reacting to the last painful burned experience. And what we're going to do through learning in this way with our trusted others is learn to develop a coaching eye. And by that, I mean when you have learned to separate your trading ego from the act of assessing, when you can adopt the principles of doing good staff work, being your own coach, or a coach for others, analyzing your work, and then making executive decisions about how to improve the performance of the team, what you've really done is created a professional persona that will give you the moral strength and the habits of mind that prevent you from chasing your own tail and following your impulses during the execution phase. So, one of the advantages of good learning and good assessment is not just that your rules get better, but it gives you the psychological strength and resilience to follow your good rule sets under times of crisis. And that's one of the things that you get an edge compared to herd animals, which are acting on knee-jerk responses to surprise moments that occur in critical states. Now, when we do after action reviews, we're really taking a look at what we did during planning, preparing, executing, and assessing this entire process on a trade by trade basis and a day by day basis. And we're going to look for ways that we could continue to do the good things that we did and avoid the dumb things that we didn't do. And then we're going to look for places that we can improve our performance as a planner, and then in preparation, and then in execution. And then with our coach, we're going to take a look at assessment to see, are we developing the coaching eye? And from that analysis, we're going to find one or two things that we might do to take action going forward to improve our effort tomorrow. We're going to put all of that in our learning journal. We're going to use that feedback and systems control charts and coaching eye to get continuous improvement in everything that we do. That's what distinguishes professional behavior from amateurs, from hobbyists. In order to do this due diligence, you have to remember to spell due diligence D-O. Due diligence means you got to do that. You've got to do that work if you want to leverage the power of this style of trading. That's everything I want to say broadly about swing trading in context with a process in a professional way, leveraging the idea of compound critical states. I want to actually give you some news that you can use. So I think we covered this in an earlier one, but just to make sure, what we are going to use in the templates is the idea of two things move price in massive ways. Two things contribute to critical states. First, the location on any time frame. If you found the maximum and the minimum and said the bottom and top 10% are places where extraordinary moves can occur as a result, everybody's expecting it to break out, or no, everybody's expecting it to revert to the mean. Well, it's half and half. So each one of them is prepared to act with the emergencies and emotions. So that's where the extreme move comes out of, a move to the top of a trading zone or the bottom of a trading zone. And it turns out if the trading range was wide enough and you were in a quiet little spot right in the middle, and if that was your risk in a doji, you might actually have 3 units of reward before it even goes up and tests the high or the low. And that creates our most unusual little pattern called the fence sitter, which is a guy that is absolutely indistinguishable from all the members of the herds. He's sitting right exactly in the middle and is so quiet that once he starts running, it's an explosive moves and nobody's prepared for that. That's the basis of the fence sitter. Well, if we applied that time sensibility to multiple time frames, just on location, what we would end up is having not just a critical state up here or here or right in the middle. But if we use that for strategic long-term traders that are looking at things, let's say the last 30 weeks and 150 days, we might call them the strategic position traders. And if we looked at short-term news-driven, emotion-driven, tactical short-term guys, we might say 10 days is a short term. And we might pick like slow swing traders or the beginning position traders might be thinking about things on a 30-day basis. Now suddenly I can perform this location analysis. And what I want to see is one, two, or hopefully all three of them in an extreme condition simply on the basis of location. Like if they were all oversold, well, as soon as that thing breaks to a new low, all three of those guys are confirmed that, oh, this thing is collapsing, and they all pile in on the downside, and you get this extraordinary move that amazes them all because they weren't expecting that much volume. And the same thing on the top side with the fireworks. You get this and you get that. But if everybody was waiting for it to collapse and it didn't, and some brave souls start pushing it up, you might see a strong reversion to the mean. And so things that were oversold, instead of failing against all odds, become Godzilla. Enraged, and he moves up with explosive dead cat bounces off the bottom. Well, you don't have to get the whole thing. An explosive Godzilla move off the bottom pays for itself and all its children out until the seventh generation. Sometimes that thing has moved down to the bottom and is so quiet, like a big fat catfish just getting bigger and fatter. And when he finally starts to move, you see the beginnings of momentum, and it slowly builds momentum, and you get a longer term recovery or a slow failure that begins to attract more downside momentum. So the catfish and Godzilla both live on the bottom. One of them explodes, the other one slowly gains speed and goes. On the top side of that range, you got the fireworks move, which is extraordinary move and breaking out. And you say, what's this going to do? The fireworks just keeps going. The Humpty Dumpty says, oh no, not so much. I'm starting to fall all the way back to the midpoint. And all that money you earned during the asymptotic move up, you're going to give it all back because you didn't have an exit strategy because you believe that you were right this time. Well, that's not good. Well, that's what I mean by location will generate compound critical states. But volatility also creates critical states. Location triggers your rational mind because you can see it. You can see where it is between the bumper pads. You can see it ready to rebound or ready to crash through. Your rational mind accepts that. Volatility, however, is taking a look at the degree and the size and the speed of rates of change between buyers and sellers. Now, there's three kinds of volatility. There's sort of and we're going to establish it by looking back over our time frames, and we're going to compute 5 days for swing trading and say that is 1 unit of measurement. And we're going to go back 30 sets of 5 days, and we're going to find out how quiet or how extraordinarily large each of those 5-day ranges are. We're going to each day update the average. We're going to compute the standard deviation of those 30 points. And we're going to just say that if you're within plus or minus 1 standard deviation of the average, this is just normal volatility, nothing special. But if you're more than 1 standard deviation away from the long-term average, that is so quiet that when the move starts to happen, like a big stone in a quiet pond at night, it gets exaggerated and will attract everything, and the herd will start to spook, stampede. So from quiet conditions, like a catfish or Humpty Dumpty, you get these large moves. But you might also see a target that's already on fire and moving, and that's the easiest one to see. It's at an extreme location and it's moving hard. What are the chances that there's only a 1-day volatile event that immediately corrects it back to the rational fair price and everything instantly goes back to normal? The chances of that are non-zero, but it's closer to zero, you know what I mean, than 100%. So the volatile is usually, I think of as the second day. In a perfect world, we have something that was in a compound critical state on location and was quiet. Those last 4 or 5 days were so quiet. And then suddenly it moves with one big day. And that one big day is going to start attracting buyers and sellers. And that's going to drive it up quickly into the volatile category. So you might get something on day one that was quiet and it quickly proceeds up to volatile. And you might end up getting a 5 or 10-day directional move that is increasingly volatile until it starts to roll over. And now there's no more interest in it. And now your disciplined rules get you out of a position that you love, but it requires you to get out. That's what the herd cannot do. The herd cannot do that because they only remember the infrequent joy of a wildly successful move. The hardest thing to do is get into them, except getting out of them. Getting out of them is harder than getting into them. Because on the entry, you're just following the rules of the template and you're not emotionally committed, but you get a successful trade. Your trader professional discipline must respect the exit rules. And that's why I say that if you're going to spend whatever time you spend on exit management or on decision management, you should be spending 90% of it on how you adapt and adjust the rules until the market decides you exit and not try to overthink the setup and entry conditions. Now, Chris, I just got to tell you, I'm in despair. There's 10,000 targets out there. There's all this work to do. If only there was some kind of standard reliable toolkit that never got tired, that instantly calibrated patterns and auto framed them and set it up for you to see so you could get confirmation. I almost, maybe someday is what we could do. Here now, before we drive into that, let me just say quickly, Chris sent me the setups from Thursday. He gave me a list of a half a dozen. Here's what happened on day one from the handful of symbols that he gave me. It almost doesn't matter which template or which pattern caused them to be a good target. You know that if it hits any of the mechanical swings or of the auto framer or the sniper patterns, it's good enough to trade. It's in a compound critical state and massive goodness can occur. Here's DIA, the old, venerable, boring Dow Jones Industrials on a slow 10-minute time frame. It was in a compound critical state. It closed here at 4 o'clock local for me, or 4 o'clock Eastern. And then this was the opening range 10 minutes, which we give them the 10 minutes just to get used to it. And then we saw a 1, 2, 3 pattern using one of our standard patterns. We entered with a standard calibrated risk. It moved until it got to the peak of our 10-period regression line, which marks the top of the channel. And when that happens and it rolls over, we take the exit at the skin of the dragon, which is a 10-period Bollinger Band mean, plus or minus 0.5. And that orange dragon defines a midpoint of typical price action during the day. So this little move from a standard position with standard work on a compound critical state earned us 1 R, in other words, $1 of reward for every unit of risk in 40 minutes. The next typical standard pattern that it had was after it rolled over and went through the dragon and triggered the PSAR and the intraday volume weighted average price, we got our entry as it crossed the Bollinger Band mean. It's the same size risk because that's our standard template. And it went down this far. Here's where the RL10 reversed. We took the exit and we got a fraction. If you don't want a fraction, send it to me. I'll take every fraction that you don't want because just because. Call me crazy. Well, instead of rebounding and oscillating back up to the previous high, it never even got through the Bollinger Band mean or the PSAR or the VWAP. In fact, the failure to follow through told us that, in fact, when it goes below the belly of the RL10, that's a collapsing dragon, one of our 4 standard patterns. We follow it until the RL10 reverses, and we take the exit, the skin of the dragon, for an additional 1R. So on 3 trades, we were 3 for 3, and we netted 2.3. So if you were trading $100 of risk per share, or you were trading $1,000 of risk per share, you made $230 or $2,300, depending on the trading vehicle that you were using for DIA. Standard work from a compound critical state. He sent me US Steel, opening range 10, standard entry, standard risk 3R, standard reversal when the PSAR flips and it crashes through the VWAP for an additional R. That's 4R. So that's net 6.5. He sent me NVIDIA, breakout, reversal for a scratch, reversal for a big win, and another scratch. So 2 out of 4 trades paid off. 4R on that one. EWZ, same thing. This one got about 2R. The point being that from the templates that come out of the mechanical patterns, the auto framer, the sniper patterns, once you have that, once you have framed those trades, you're going to manage them in a standard way. No matter what reason I have to consider them to be in a compound critical state, they all have this quality. And all I got to do is get my risk out as soon as I can and then manage the exit according to standard rules. And then I only need to know 4 patterns, which we teach in Griff and Phil's course, and I'll send you the details on them. You can watch my free nightly podcast, and you'll watch me coaching traders every night that start with swing trade patterns, trade them intraday, and then the ones that really go well, they turn them into swing trades. But you don't have to do that. You can also just trade the swing patterns with the rule sets that Griff and Phil will give you. And you can just trade those on a day-to-day basis with end-of-day data. But when you see the stats and when you use EdgeRater to take a look at the consequences of improving your exit management, you're going to end up saying, you know what, it sure makes a lot of sense to spend a little bit of time managing my exit rules with good enough entries, good enough patterns with good enough entries, and then work on my exits, and I can begin to generate an additional stream of income with very low cost in terms of time. And if I want to, I could decide to move into the world of day trading if I wanted to. Like, I might decide, I wouldn't recommend it. It's a lot of work. But you could just day trade those things. But you could also just swing trade those things. Or you could pick times when the swing trade is primed and ready to go and decide that's the one day out of 5 that I really want to be a day trader when I have a lot of goodies on the swing trades that are ready to pop. And then you can pick and choose the day you decide to day trade. And when those are successful, you can dump those off into longer term trend following systems that uses markets money to fund the overnight risk with wider stops. You got to have wider stops on longer term systems to account for the increase of noise. so you can manage more positions, but you'd like to fund that with things that are coming from lower risk, in my view, swing trading and day trading. That's what I want to say about the idea of advanced hybrid swing trading. I do want to show you, these were the particular patterns that you sent me. This is a daily chart now. And I can tell you by inspection that Alcoa is a fence sitter. It's midway between clearly defined support and resistance. Like, I'm not allowed to be surprised if this move, which went from here to there and is now moved halfway up, I'm not allowed to be surprised that it goes all the way up into here. And if I can use yesterday's range as a risk, I have a 3-to-1 reward to risk on the way up. Done. I have at least 2-to-1 on a reversal. So there's a compound critical state for you, which I could trade just with end of day data. So I could go into the day with that in mind. If I looked at it on a 30-minute chart, it turns out that it had 2 really good moves during the day. It did this, a gap up and sell off. That's tradable to a day trader. A move from 40 to 38.90, that's $1.10. And on Alcoa, our typical risk box is 20 cents. That turned out to be a 5-to-1 reward to risk payoff. And oh, by the way, when it finds support at the Bollinger Band mean and the previous levels of support, we're not allowed to be surprised if it moves all the way back up and goes right to where it started. So you have potentially a 5R in both directions, and that's just on 30-minute bars, which is pretty slow. And if you looked at it on 3-minute bars, you would realize that those were both very easy to detect. This is your opening range 10, and when that breaks below and crashes through the VWAP and the support, you get the first move, you get the recovery move, and you get another recovery move. So those are all manageable intraday off a symbol that alerted you because it was in a compound critical state on a swing trade basis. Archer Daniels Midland initially had big move, and this was kind of typical of Friday. Big moves right out of the get-go. Here's the opening. Big moves, big responses, double big move, tradable. Amazon was on his setup list. This is like falling off the turnip truck. I mean, really. Here was yesterday's close. There was a opening range 10 here. You actually get the first move, and when that fails and then goes through the Bollinger Band main and through the VWAP, you get this entire move, and you get to make money while Jeff Bezos is losing. So you get the moral high ground as well as the snarky satisfaction of taking money out of his pocket. Baidu, big intraday moves. Those are all surprises that catch people that are unprepared on the wrong side of the moves. Big moves in BNED. ELF was this one was just astonishing. I mean, this is like a jewelry company or something. Here's where it closed. It had a big gap down. It ran up, couldn't make the move, so it established an opening range 10. You get this move, and you get that move right out the gate, and by 90 minutes later, you'd made your weekly move. If you specialized in it, you might like the rising lows, which is our Kata 2 formation, which Phil and Griff teach. The Kata 2 formation as a pattern has a win rate of about 60% and pays off anywhere from 3 to 2. We've got some guys that are getting payoffs as high as 3-to-1. That's the kind of thing you want. Excellent reward to win-loss rates and average wins to average losses that are favorable. You'd like to have that problem when you have a lot of opportunities. GLNG right out of the gate. So what I'm showing you here is the first day move after a swing trade compound critical state. Your standard trading techniques will work with you in this. We can teach you how to do it. But if you start with something that's ready to just explode, as a professional trader, you should be able to go. LI, once it finally breaks out of the lunchtime congestion, after a big gap down, so you know it's in play. Now, when everybody is disgusted with it and it breaks back below the VWAP, you end up getting a long, painful slide, which reinforces the narrative that this thing is in trouble. We knew it was in trouble up here because it was in a compound critical state. It could have had extraordinary gains. It could have had extraordinary retracements. Up, it turned out to be B, extraordinary retracements. Now, in a move like this on a Friday, you could very well see that any price below this support level is going to become a swing trade in that direction. So even if you didn't get this move, you are positioned for a swing trade follow through, which is a very efficient way to find your targets. MRUS, big moves intraday, plug power. Oh my God, this thing, it's a low dollar value, but that was a 10% move intraday between its pricing action up here. Once it collapses through the VWAP, off you go, and everybody hates it. You know why they hate it? Because, if I have to say it, Biden was so bad that they think the Republicans are going to win. They're going to turn off the spigot to government subsidied green power and plug power. That's what happens. Now, here's one. I want to show you SPXS for those of you that are trading futures, options, or the big fat indexes. So SPXS was in a compound critical state, and what it did was from the opening, so this is the triple SPX. So it moves from 780 to 758, 28 cents on a 3-cent standard risk box. That's a 9R move. You don't have to get all of that. You don't have to use a 3% trailing stop, but you have two measured legs down, and you'd be happier than a dead pig in the sun to walk away from the market with that. Except then you realize, oh, there's that move all day, which simply is using buy on retracements. And that's what the COTA 2 pattern gives you. It gives you this, 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 and this. And you don't have to get all of them. You could start with the supported spring crossing, which we teach in the COTA 2 course. And oh, by the way, I'm showing you this on 3 minutes. This works on 10-minute charts, 30-minute charts, daily charts, 3-day charts. All of the 4 patterns that we teach in the sniper trading are fractal, and they will work on any signal that you come up with that comes out of the compound critical state. Now, I want to stop there because I've said enough, I think. If you may be interested in some of this stuff, I hope so. Chris, I want to turn it over to you because I know you had run some additional setups, and maybe what we could do is, if you want, we could take a look at some of those, quickly pull them up, and what I'd like you to do is show how you don't even have to. This is why I admire you so much. I don't even have to draw my boxes and shades. You auto frame it beautifully by clicking the symbol. If you could demo that, I think we'd be in good shape to show this in action.
Absolutely, yeah.
And then take questions and answers after that.
Yeah, for sure. Let me share my screen. You can see my screen now, right? Yeah. So I've run this for. It's a list of 600 stocks. This is the stocks that are CBOE weekly optionable stocks, and then this was run on Friday. Today, using Friday's end of day data, and so this is the list that you'll see today if you run this in EdgeRater. And so, just as Ken has shown you from the list yesterday what was happening intraday, then this is be something to look for. You got to watch these on Monday essentially. But out of the whole list of 500, there's only 6 that are in the fireworks critical state. We can quickly kind of just view those on the chart. So for anybody who doesn't know how EdgeRater works, you basically run a template against a list of stocks, and then it will produce a report that's defined by the template. And then it's very interactive with the chart. So as you're scrolling down through the various symbols, either clicking on them or using your keyboard to scroll down, the chart will just immediately update with the indicators that have been configured for that particular template. And so in this case, we've got the indicators that Ken is looking for on here too. So the 6 that appeared for the fireworks were Discovery Financial. I'll just quickly run through these. We've got FedEx, you've got Kinross Gold, NU, whatever that is, Redwire, and then the last one is SNV. So that's how you quickly will see that. When you look in the columns, you'll see the number of signals that have occurred in your symbol lists. So we know we ran this on 600 symbols. That's listed in the count. And then we can see that there are 6 for fireworks. There are no Humpty Dumptys. There's 6 fence sitters, 12 Godzillas, and 17 catfish. So I don't know if any of those in the fireworks category, Ken, that you are.
Yeah, just let me talk about the one that's on the screen. The idea
Okay,
behind the idea behind fireworks and the idea of the trade location. There was a question in the how do you calculate the trade? So all we do is we do an index. For that look back period, you find the lowest low, give it a value of 0. The highest high gets a value of 100, and it breaks it into 100 standard units of measure. And then wherever price currently is located on that scale of 1 to 100, it gets that numerical value. So when you're looking for fireworks, I want you to notice that on this particular symbol, there was 1, 2, 3, 4, 5, 6 different times it has come up to that resistance level. And it's really positive enthusiasm because they keep buying it, but they're not able to break through. Now, in all previous 6 cases, when they couldn't break through, you get a vigorous move in the other direction that lasts multiple days, and that's a swing trade. A larger than normal move in a shorter than average period of time in either direction. Let me tell you what's going to happen if that thing breaks through those 6 levels of measured resistance. It's going to look like it did back in probably December, and it, instead of failing, explodes to the north. And then everybody that's shorting that thing on the explosive move up has to scramble to cover it, and you're going to get a short cover. You're going to get a short squeeze that makes that thing to be an explosive move to the upside. So from that ending location, right at the limit of resistance, with a very small risk, you can expect or wouldn't be surprised if you saw a large move in either direction that could last 2, 3, 5 days. That's a perfect swing trade until the new price normal is found. Clear?
Mm-hmm. Yeah, very good.
Yeah. Go to the Godzilla, just for if we could. Pick a Godzilla, because I want to show one at the other end of the spectrum.
Yep. So I'll just double click on there, bring the Godzillas to the top, and then we have the list of stocks there at the bottom. Yeah.
Look at the trail of tears and the drama of human emotions. What you had was a Godzilla way back in looks like November, and then against all odds, that thing exploded from 7 to 24, which is a 350% move in 6 weeks. And then they kept trying, and it slides, and they try, and it fails, and then despair, and then a big gap down, and then horrible, and then all the way down to just absolute disgust. And now where we're located, we are at the end. We are in the bottom 10% of the last 150 days, the last 30 days, and the last 10 days. So everybody who used to be positive about this thing are in absolute despair and disgust. And everybody that was going to sell sold. Now, it ended in a little red candle that's kind of a doji. If that thing breaks out of Friday's high, it's going to start climbing the wall of worry all the way back up to the green line, level one, and then the red line, level two, which is the 10-day high, probably, or 30-day high. Sorry. So if you get the move just to the green line, you're going to get a 3-to-1. If you get the move to the red line, you're going to get probably 7-to-1. And that's not an irrational move. It could move that far in 3 to 5 days simply on the basis of the evidence of our eyes. We can see that those are not irrational moves. But guess what happens if it breaks below Friday's low? It's going to break through 7. And if it breaks through 7, they're going to look back and say, oh my goodness, this is a new 150-day low. That means there's a whole new group of short sellers that are going to come in and pound this thing into oblivion. So I don't know which way it's going to go, but if it starts breaking out of Friday's range, there's a reasonable chance of a larger than normal move in a shorter period of time than normal in either direction. And as long as I don't have an emotional commitment to it, if I don't have a directional bias, all I got to do is frame it. Oh, I don't even have to frame it because Chris already did. And all I got to do is follow the rules and follow the price and manage my exits so that I have a professional response to changes in price behavior. That's the secret of this thing.
Nice.
So that's what a Godzilla looks like. Are there any fence sitter? Go pick a fence sitter like maybe
Yeah.
BlackRock. Yeah, pick BlackRock just so we can kind of see the midpoint of what that
Yeah.
yeah, that's
There
good.
we are.
So if we looked at the last 150 days, this thing is relatively in the middle. It's relatively in the middle of the last 30 and the last 10. It's ready to go left or right. It's like, imagine a chicken was crossing the road and is stuck in the middle and looks to his right, says, oh my goodness, there's a truck coming. I don't know which way he's going to go, but he's going to go. And it's a coin flip. But once he starts going, it's going to really go. And that's the main idea of the fence sitter, that you would not expect to see that on anybody else's standard setups for a high payoff swing trade. I defy you to find a rule system that's out there that says that setup is ideal. It turns out that you can make an equally strong argument for a large move with multiple legs in both directions precisely because it's in the middle and it is in a quiet state of mind. So that's what I'm going to say about that.
Right.
Derek asks in there, can you pick optionable stocks with higher open interest? I'm certain that that's possible in EdgeRater. Not an expert.
Yeah, I did. Yeah, I sent just a note to everyone about that. Just the liquid options list is a list that's been sort of pre-compiled based on it's 250 stocks, and it's based on looking actually at the database of options and finding out which ones are have the most trades per day. So yeah, that list would be the one to use. The other list you can use would be the CBOE weeklies, because the weekly options do tend to be more liquid, but there are quite a number in there that actually aren't that liquid.
There were a couple questions in there. One was, do I play soccer? Yeah, I coach. I've been playing for 40 years. I now have the fitness level of a 8-year-old girl, and that's who I coach on my academy soccer. I run the technical training camp for community soccer and sit on the board. The slides will be available for further study, including an 180 page book on standard swing trading ideas. It is my opinion that if you are trading against the herd, you better know everything about the herd. And so I wrote a 180 page workbook that expresses the best practices of swing traders of all different kinds and puts it all into one sort of book of common knowledge. And I think that's what you should understand it. But we do things that leverage our ability to fine tune that or to work against the herd or to work in our way. But I think you got to respect the opponent and respect the market by understanding it kind of at a top level. So that's going to be available to you. All the slides I will make available to you. Happy to do that.
Yeah.
Could you show them where the templates are? I see a question in there that says, where could we find the
Yeah,
templates?
yeah, I did reply to that as well, but you can
Oh,
find that on the website under the products EdgeRater. So it's edgerater.com/products/template gallery. So if you're ever curious about where you find them in the EdgeRater program, because everything is put into its own categories, you can do a search on this web page for Ken Long, and then it will show you the templates, and it lists right here which category it's in. For Ken Long, it's very straightforward. It's in the Ken Long category.
yeah, yeah. Now there was Mike Batoyer asked, can the framing be done on a 30-minute as opposed to the daily? Yeah, my recommendation is that you use the daily time frame to run all the sorts, because you got many more people that are engaged in amateur swing trading than you have engaged in professional day trading. So what you want to start with is something that's very potentially jumpy and meets all the criteria for a swing trade on daily charts. Once you have that framed, you can then drop into the 30-minute window, and then with your standard charting packages, you can see the turning points more easily intraday. And I have 2 years of recorded live daily swing trading on 30-minute charts that we provide to our folks, just to on 30 different symbols, just to show what that looks like day to day, and we debrief that every night. But that's one of our trading reference courses. That's I'm happy to give you guys a discount if you want. But yeah, to me, the 30-minute chart is a beautiful blend between very slow day trading and very fast swing trading. So you don't have to decide which one you want to be. You can actually start with the 30 minutes and go in either direction, which is what a lot of our guys are doing. Over.
Yeah.
Oh,
Well, there was a interesting question that is asking if a fence sitter would be good for an iron condor strategy. My thought,
100%.
yeah.
Yeah, it's a great break or a better. I'm not an options guy, but I got a couple hedge fund guys that are options geniuses that are in our coaching program, and what they're doing with the application of these ideas to their option strategies, I'm speechless when I see what they're doing. I should be
Yeah.
charging them 100 times. I was foolish, and what I should have said was, give me 1/10% of the improvement that I'm making in your trading, instead of just charging them a dollar figure. I won't make that mistake again. But yeah, the option strategies that can be applied to these compound critical states are very interesting. We have a course on that as well.
Mhm.
But yeah, happy to help with
Yeah, and
that.
one thing I'll just say with EdgeRater, there's a very unique template that you won't see this information in many places, not very easily accessible. It's the ability to draw a line on a chart. So we'll take this BlackRock chart and we'll take from the high here to the low down here. And then we'll look over on the performance between dates template. And if there were options, which there are, we can see the performance of all of the options over that time frame. So that is all of the deltas from basically 1 to -1, and all of the expirations. And then it's plotted on a chart up here. So in that time frame that I highlighted, which if I just bring the chart back up, that was a series of 10 bars or so. It's just showing you the highest gain of option there, obviously the lowest delta, because it was a very sharp move over a short time frame, but that did make 800%. And then all of these lines will tell you the gain for all of the other options. And the table below gives you the actual numbers. This is using real data. It's not just made up using various implied volatilities. It's actually looking at the options data for end of day. So these are real numbers. And you can do this on any chart that has options. You can just draw a line between 2 points and it will tell you the gains of the options. So yeah, so that's a piece of data that took a long time to put together, and I hope everybody is taking advantage of that.
Yeah, Chris, I want to respect everybody's time, and I did want to say that look, we got a Phil Wu and Griff Cooper are going to run a 2-week swing trading course focused exclusively on EdgeRater templates and theory and practice. There's going to be one day that one of the weekends is going to be on the theory of how to find the patterns and use them and frame them and trade them. The second one is how to use the EdgeRater's amazing backtesting capabilities in order to backtest and refine entries and exits and money management and all that jazz. You get an amazing discounted coupon there. It's a beautiful course. I did want to, if I could say that it's going to come with some coaching, and if I may share, I feel like I need to share this idea with you guys. Last week I was in a learning workshop with the commanding general of all U.S. Army schools. He's a 3-star general. He's got 25 schools under his responsibility, 7,000 faculty members, and 200,000 students a year. And I was a keynote speaker, and what he asked me to brief was this idea here. And so this is the top level idea that I briefed the commanding general of all Army schools on. And it turns out that what works for educating Army leaders works for traders, because the mindset, the risk management, the executive decision making, operating under conditions of risk and uncertainty with significant consequences of failure is really the same thing. And what I showed him was that the courseware that we put together to help leaders become confident communicators actually is generalizable on how to improve all of your professional performance. And what we showed was that when you have professionals that are trying to learn new skills, like trading, that you go through a 3-phase process of discovery, you get over the anxiety, and then you learn to develop skills. And then when you get enough mastery, you can really get into high performance. But it starts with an assessment. And what we found was that people fall into one or more or all of these categories to some degree, which makes it difficult to learn new things. Like introverted experts would rather work in the quiet on their own by themselves and not be in public doing things. And then there are other guys who get promoted from their level of expertise into a leadership position that they don't feel prepared for. Hey, you were successful as a doctor, you should be successful as a trader. And then there are folks who are cursed with anxious perfectionists, the analysis paralysis. It turns out that we put together an assessment instrument that found 5 measured areas for each of those. We could determine if you were having troubles in those areas, what was a positive strategy for each and every one of them that combined cognitive skills, emotional skills, and practical skills to make improvements in each of those areas. And that once you get enough confidence and skills, you actually can leave the fear and anxiety behind and then work as a diligent student to perfect your learning in a systematic way, being a mindful scout to make sure that you're looking at the next most important thing, and then have the persistence of a badger to just keep going no matter what, and to look at every obstacle as an opportunity to demonstrate your badger nature. And then once you get to a certain level of skill across the board, you can then become a Dharma warrior or a spirit warrior or a leader with vision who is aligned towards the final objective, who brings a lot of different resources to a team, and that can be a catalyst, and then are inspired by the skills of a master craftsman. We actually have a performance improvement model that the Army's employing that I've adapted to use in our coaching program for traders, and you can take parts of it or pieces of it. I'm happy to share that with you. This gives you an edge that is pretty rare in the world coming from this direction. So I just felt it was necessary to say that while we spend a lot of time in our head worrying about technical issues, there's a whole emotional center that we have to contend with, which has an impact on our performance. And most of the work that we do inside here in this discovery phase is learn how to strengthen that internal warrior to build resilience and resourcefulness and persistence so that we can survive long enough to learn the technical skills that are pretty straightforward from the hand of a craftsman. So I just wanted to say that I really want to share that with folks, and I want to let you know that that's available. So
Great.
back over to you, Chris, and any other questions that folks may have. I wanted to
Yeah. Let's see if there are any new questions. I haven't seen any new ones coming in. But I know that you're going to be participating in the course that Phil and Griff are running.
Yep.
And just to kind of clarify the time scale of it, it's over 2 weeks, so it's not actually for the duration of 2 weeks. So it's going to happen on basically 2 Saturdays, and it's going to be the afternoon from noon till 6 p.m. On the July the 20th and the 28th. So 2 long afternoons. And Phil and Griff are going to be teaching, and Ken is going to be there as well with some information.
Yeah, I think my role in that one is to answer the questions that they don't want to, or I'll answer the questions. So what we're going to do, we've collected a set of questions already from the dozen people that are already in there. We can scale the size of that up pretty easily. We're going to record all the sessions. You'll have lifetime access to the material. You can ask your questions. We'll answer them all. You'll get that 180-page swing trading book plus a bunch of other goodies. If you take that course, I'd be willing to throw in the opening piece of that coaching program as well, the self-assessment, and then give you a personalized strategy for self-improvement in those areas. Happy to share that with you as a gift. Oh yeah. If you could send me the email longke@yahoo.com. I think otherwise it's Ableway Tech. Ableway Tech.
Yeah.
I think I put it in the chat. If you hit that, ablewaytech.com, that'll get you there. Oh, there it is. Look at us.
There we go. Okay. Well, we ran over a bit, but I think with good reason. That was excellent. I really appreciate it. Thanks so much, Ken, for your knowledge and inspiration. It all sounds really good, and I hope people are interested in what you have. Is years and years of knowledge kind of in your that you're sharing, and well worth somebody spending time and going through that.
Yeah. I saw a question from Tim Clark. Is that my Tim Clark? Is that my buddy? Send me an email. You're in.
Great. Okay, so if there are no more questions, we will leave it there.
Yeah, Tim and I go back a ways. He was one of early attenders at our research weekend and live trading weeks, and did groundbreaking work on the use of the MACD histogram and the 4 seasons, which influenced all of our views on seasonal trading in a very deliberate swing trade model. And just sure is good to see him.
Yeah.
Okay, that's all I get.
Great. All right. Well, thanks everybody for coming. Enjoy the rest of your weekend. Hope you're going to be watching the Euros tomorrow.
For sure.
Okay. Thanks, everyone.
Take good care. See you guys later.
You too. Bye.